So we have just closed the first half of the year for tax year 2026. And most of you are starting to think about doing some tax planning between now and the end of the year, because obviously all the planning needs to be done prior to the end of the year, because when it comes to 2027, you'll be prepared to pay the taxes for your 2026 revenues and income. So for the 2026 tax year, if you happen to be married and you're filing jointly, there are 7 tax brackets that you need to pay attention to. So you have the 10% bracket, and you have the 12% bracket, you have the 22% bracket, the 24% bracket. You also have the 32%, the 35%, and the 37% for high income earners tax bracket when it comes to your federal income tax. Now, between 0 and 24,799 of income, I call that the 8th bracket, because the tax bracket for that is 0. Now, obviously, that number will increase depending on your age and what it is that you may be claiming. If you're married filing jointly, it's going to be different than if you're married filing separate, or if you're single, or if you're head of household. But it's important to note that when you're prepared to file your taxes, you have to understand how taxation works in the United States, because it's very progressive in nature. So the more income that you generate, the higher the tax bracket. So once you go over the 10% threshold, which in this case would be, let's say, $24,801 to $100,800, anything over that, you're now going into the 12% tax bracket. And then you'll get into the 22% and the 24%. And only the portion that happens to hit those individual brackets that I just talked about, will you be taxed at that level. So if your income is, let's say, between 0 and $24,800, you're going to be taxed differently than if your income was, let's say, north of that. Obviously, there may be a surcharge depending on the gravity of your income and the increase in your income once you get into the 37% tax bracket, but it's only the federal level. So you have to make certain that if you're in retirement and you're going to start taking distribution out of your IRAs and your 401ks, and if you happen to have a part-time job or you have already applied for Social Security benefits, all of those things are going to form part of your provisional income calculation that will determine what percentage of your Social Security benefits may be taxed in retirement. If you don't do your due diligence, chances are your Social Security benefits will be taxed, and they may be taxed up to 85% or whatever the benefits may be. So it's important to keep an eye on that. Most of the planning should be done prior to the end of the year, because once you have earned all that income at the end of the year, it's about paying the taxes, not about, the planning aspect of it. So if you have any questions, please feel free to reach out. My name is Bert Salazar, and my telephone number is area code 888-477-0108. You can also send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I'll be more than happy to schedule a 20-minute conference call with you and answer any questions that you may have. So thank you, and we'll talk again soon. Take care. Bye-bye.